Kia ora, I'm Mary Jo, Kiwibank Economist. Now, as you know, New Zealand is currently facing a COVID community outbreak, the first in over 6 months. The whole country has been put under alert level 4 lockdown. And given the heightened uncertainty at the moment, the Reserve Bank decided to keep the official cash rate on hold at its August meeting. Now, there's no doubt that the Reserve Bank would have delivered a 25 basis point rate hike had we not gone into lockdown. The Reserve Bank's new forecasts were revised significantly and ultimately paint an economy that's running hot, which comes as no surprise. It's been well documented that we're facing major capacity constraints, labor shortages, and rising inflation pressures. So there's actually no need for monetary policy settings to remain this stimulatory. And when reading the Reserve Bank's latest policy statement, it's clear that they had every intent to lift the cash rate. What the current COVID outbreak has done is simply defer the decision to raise the OCR. In fact, although the cash rate was kept on hold, the OCR track shows a front loading of hikes. The new track signals a rate rise by year end, and the cash rate is forecast to hit 2% by the end of 2023. Now, the August OCR projections are much more aggressive than market pricing and even our projections, which sees an endpoint of a 1.5% cash rate. Now, the timing of when the OCR is eventually increased depends on how the current COVID lockdown impacts the economic outlook. If the lockdown is kept relatively brief, then the medium-term economic outlook remains broadly unchanged. And given the Reserve Bank's bias toward tightening monetary policy, rate hikes this year would still be on the cards. But if the lockdown is prolonged, and importantly, if demand takes a significant hit, then rate hikes would just be postponed further. It's clear we're in a period of watch and wait and see. That's it from me this week. I'll talk to you in the next one.